Assalamu alaikum friends. Today we are going to discuss the topic participants of derivative market. But before moving towards our main topic, for our better understanding we will define the derivative market first. So what is the derivative market? The derivative market is a financial market for derivatives, financial instruments like future contracts or options which are derived from other form of assets. So here we are clear about what exactly the derivative market is. Now moving towards our main topic, that which type of people participate in derivative market and why. Firstly, we have the hedgers. Hedgers are those investors that enter the derivative market to reduce their risk or to hedge their risks regarding future events. The parties who perform hedging is known as hedgers. They are the risk avoiders. They try their best to avoid the risk or minimize the risk as much as possible. The existing exposures. So they are facing the risk and they are facing the risk in the present, and so they want to minimize it. And the next is their objective is to reduce the risk. So for our better understanding, here we are going to take the example that there is a farmer in the village who planted the wheat, and after 3 months his crop will be ready to harvest. And there is a investor who want wheat for his bakery, and he think after 3 months price of the wheat will increases. But on the other hand, the farmer thinks that the price of wheat will decreases in the future. Both of them are facing the risk and they want to minimize the risk. For this purpose, they will go into the contract. They will sign the contract, and the contract is that the farmer will sell the wheat after 3 months to the investors for rupees 50. So here the farmer hedging the risk by signing the contract to sell, and the investor is hedging the risk by signing the contract to buy. In this way, both of them are securing their future. So if the prices fluctuate in the future, it will have no impact on them. So this is the idea that, or the technique that the hedgers use to minimize their risk. The next participants of the derivative market is the speculators. They are basically involved in betting against the future price movement and taking position accordingly. They are the risk takers. They do not have any risk to hedge, earn profit on the basis of price assumptions. Loss impossible. Possible. Loss is possible for them. As we said in the previous example, that there is a farmer who is a harvester, who is having the crop, and there is an investor who is having the bakery, and both of them are signing the contract to hedge their risk regarding the future prices. But the speculator is the one that neither this man have crop nor bakery, but still he is going into the contract, and the reason is that he wanna earn profit on the basis of price assumptions. They study the market very carefully and predicts the prices accordingly. For example, speculator expects that the prices of the wheat will increases in the future. So what he will do, he will sign a contract with the farmer that he will purchase the wheat from the farmer of rupees 50, and after 3 months when the prices of the wheat will increases, he will sell the wheat on the higher prices, and in this way he is making the profit on the basis of his assumptions. Now the last one is the arbitrators. The arbitrators, they buy an asset in the less price and sell it in the higher prices in another market. They make a risk less profit, earn profit on the basis of mispricing between the markets, and the loss is impossible for them. For our better understanding, we are going to take an example. Let's assume buying a share for rupees 50 in cash market and selling it at rupees 55 in the future market. So what exactly they are doing? They are making the profit due to mispricing that is existing between the two markets. So they are making the profit, and this is the technique that the arbitrators use, and for this reason and due to this reason that the loss is impossible for them. This is a very good technique, but of course, if you wanna use this technique, you must have the two markets that have the different prices pattern. So here our topic ends. But still, if you have any queries, you can ask it in the comment box. Thank you very much.